There's a number that has existed for over a century. It does not care about wars. It does not care about elections, central bank decisions, inflation reports, or any headline you will see this week. It moves according to its own logic. And right now, that number is telling you something that almost nobody in mainstream finance is saying out loud. The gold to silver ratio just hit 56. If you have never heard of it, I'm going to show you in the next few minutes why this single number, one number, has predicted every major silver explosion in modern history. And why hitting 56 right now in this specific market, with this specific set of conditions underneath it, changes the math on silver in a way that the price you see on your screen has not caught up to yet. Gold is at $527 per ounce today. Silver is at $89.48. Divide those two numbers, you get 59.5. Round it to where it has been trading this week, and you get 56 to 57. That is the lowest this ratio has been since February 2021. And before I tell you what happens historically every single time this ratio reaches this level from the direction it is coming from, I need to make sure you understand what this number actually means. Because most people who hear gold to silver ratio think it is a complicated financial metric for traders. It is not. It is the simplest idea in precious metals markets. It is just a question. How many ounces of silver does it take to buy 1 ounce of gold? Right now, the answer is 56. You need 56 ounces of silver to buy 1 ounce of gold. That is the whole number. That is the entire ratio. One question, one answer. The reason it matters is what happens when that answer gets too far from its historical normal. Because for the last 100 years, this ratio has had a gravitational pull back to its average. And every time it has been stretched far above or far below that average, it has snapped back. Not gradually, not politely, with the kind of violence that produces the biggest gains in commodity market history. Let me show you the full picture. Because the story of this ratio over the last 5 years is the most important setup in the silver market right now. March 2020, COVID panic. Every market on earth is collapsing. Investors are terrified and running toward gold, the safest thing they can think of, and away from silver, which they see as an industrial metal tied to an economy that is shutting down. Gold holds, silver crashes. The ratio stretches to 125 to 1. Read that again. 125 ounces of silver to buy 1 ounce of gold. That is the highest reading ever recorded in modern market history. Silver had never been that cheap relative to gold. Not in 2008, not in 1991, never. But that extreme did not last. It never does. Because ratios do not stay at extremes, they compress. Silver started outpacing gold the moment the panic subsided, and the investors who recognized that 125 to 1 was a stretched rubber band, that it had to snap back, positioned accordingly. Silver surged 47.9% in the months that followed, while gold gained only 25.1%. The ratio compressed back towards 68 by August 2020, 4 months. That is how fast a stretched ratio can move when it starts returning to its mean. Then the ratio bounced, it went back up. COVID subsided, industrial demand recovered unevenly, gold retained its bid as central banks kept buying, silver lagged. By April 2025, the ratio was back above 100 to 1 for the second time in 5 years. Not 125, but 100. Still an extreme, still a stretched rubber band, still historically far above its long-run average of 50 to 60. And then something happened that has never happened before in the history of this market. Silver gained 147% in 2025, in a single calendar year, its strongest annual performance since 1979. Gold gained 67% in the same period, which was itself an extraordinary year for gold. Silver more than doubled gold's return. The rubber band snapped hard. From 100 to 1 in April 2025, the ratio has compressed to 56 today, a 44-point compression in less than a year, the kind of move that ratio traders historically wait decades to see. And here is the question that determines everything about where silver goes from here. Is the compression finished? I'm going to show you the historical answer to that question. And I want to be precise because the numbers matter. The last 2 times, this market experienced a genuine precious metals bull cycle, the kind where silver dramatically outperforms everything else. The ratio did not stop at 56. It did not stop at 50. It did not stop at any level that would feel comfortable or moderate. In 2011, silver spiked to $48.70 per ounce. The ratio at that moment was 31 to 1, not 56, not 50, 31. That means investors needed only 31 ounces of silver to buy 1 ounce of gold. Silver had closed the gap with gold to the point where they were almost the same asset. In 1980, silver hit $49.45 per ounce. The ratio at that moment was 17 to 1, 17. At the peak of that cycle, silver had so dramatically outperformed gold that you needed barely more than a handful of silver coins to buy a full ounce of gold. We are at 56 right now, In 2011, the cycle ended at 31. In 1980, it ended at 17. If this cycle follows the 2011 compression to 31, with gold at today's price of $5,327, silver would need to reach $171 per ounce. If it follows the 1980 compression to 17, with gold at today's price, silver would need to reach $313 per ounce. And if the ratio simply returns to the 50 to 1 level that marked its long-run average through the 1990s and 2000s, with gold at $5,327, silver reaches $106. Every endpoint of compression in this ratio's modern history puts silver above $100. The most moderate historical comparison puts it above $100. The 2011 comparison puts it at $171. The 1980 comparison puts it at $313. This is not a prediction. This is not a target. This is arithmetic. If gold holds anywhere near its current level and the ratio compresses further toward any of its historical endpoints, the math produces these numbers automatically. You do not have to believe in silver. You just have to believe in division. Now, I want to show you something that makes this cycle structurally different from both 2011 and 1980. Because the compression from 100 to 56 that happened in 2025 was not driven by speculation. It was not driven by a Reddit forum. It was not driven by a single catalyst or a weekend squeeze. It was driven by 5 years of physical demand destroying the supply foundation of this market from the inside out. The Silver Institute, which is the primary research body for global silver supply and demand, has now confirmed a 5th consecutive annual deficit in 2025. The shortfall was 95 million ounces. The total physical deficit since 2021, when the market first flipped into deficit, is approaching 400 million ounces cumulative. 400 million ounces of silver consumed by the world that was not replaced by mine production. For 2026, the Silver Institute forecasts the 6th consecutive annual deficit. Another 67 million ounces the world will consume that the ground will not produce. That number comes from London-based consultancy Metals Focus, the most credible research firm in the space. 6th consecutive year. No previous period in recorded silver market history has seen 6 consecutive annual deficits. Think about what a deficit means in the simplest possible terms. Every year the world uses more silver than it mines. The difference between what gets used and what gets produced has to come from somewhere. It comes from above ground stockpiles. It comes from vaults. It comes from reserves. And every year the deficit continues. Those stockpiles get smaller. You cannot run deficits indefinitely without eventually running out of accessible supply. And the demand driving those deficits is not speculative. It is structural. It is not going away when the next news cycle moves on. Global silver industrial fabrication hit a record in 2025, exceeding 700 million ounces for the first time in history. Silver demand from industry now accounts for 60% of total global consumption. That percentage has been rising every year for a decade. And the 3 industries consuming the most silver right now, solar energy, electric vehicles, and artificial intelligence data centers, are all industries with government mandates, private capital commitments, and physical build-out requirements that guarantee their demand continues for years. Every solar panel requires silver in its photovoltaic cells. Not a substitute, not an alternative. Silver. The International Energy Agency projects that solar capacity will triple by 2030 compared to 2022 levels. Every panel in that expansion needs silver. AI data centers require silver in their circuit boards, connectors, and thermal management systems. The build-out of AI infrastructure is estimated to require trillions of dollars of hardware investment over the coming decade. Every server rack needs silver. Electric vehicles use silver in their electrical systems, battery management, and charging interfaces. Global EV production is projected to reach 40 million vehicles annually by 2030. Every car needs silver. These are not maybes. These are infrastructure commitments made by the largest companies and governments on Earth. The demand is contractually obligated. The mines are not. Because here is the supply reality underneath the demand explosion. Silver mine production is structurally constrained in a way that most people do not understand. 72% of all silver mined globally comes as a byproduct of mining other metals: copper, lead, zinc, gold. When those base metal prices fall, mines cut production of the primary metal, and silver output falls with it, even though nobody is specifically targeting silver. Silver supply is a derivative of markets that have nothing to do with silver demand. You cannot simply build a new silver mine because silver prices go up. Because most of what you would be building is really a copper mine or a lead zinc mine, and the economics of that mine depend on the price of copper and lead and zinc, not silver. The disconnect between the signal and the supply response is structural and permanent. Higher silver prices do not reliably produce more silver. And on top of the structural supply constraint, the Silver Institute confirmed in its November 2025 report that global silver ETF holdings rose by 187 million ounces in 2025 alone. Through early November, 187 million ounces locked into exchange-traded products and removed from the tradable market. That is more ETF silver accumulation in under a year than had occurred in the 2 prior years combined. Every ounce locked into an ETF is an ounce that cannot be used for industrial delivery. It cannot fill a COMEX registered inventory report. It cannot satisfy a manufacturer looking for spot delivery. It simply sits in a vault in London or Zurich and waits. The market is simultaneously being drained from the top by investment demand and from the bottom by industrial demand. And mine supply cannot respond meaningfully to either. That is the physical foundation underneath the ratio compression you are watching on your screen. Now let me connect the ratio to the physical market directly, because this is the part of the analysis that most financial commentators miss entirely. When the gold to silver ratio was 100 to 1 in April 2025, silver was genuinely undervalued relative to gold on multiple dimensions simultaneously. Monetarily, because the ratio was historically extreme. Industrially, because 6 consecutive deficits were building underneath the surface. And institutionally, because the CME Group's own data showed that silver ETF inflows from institutions in 2025 hit levels not seen since the early 2010s. What happened as the ratio compressed from 100 to 56 is that the institutional money that understood all 3 of those dimensions began moving. Not retail investors. Institutions. The kind of capital that moves a market for months and years, not days. Goldsilver.com confirmed that at the 100 to 1 ratio reading in April 2025, silver was trading below $30 per ounce. Investors who recognized the rubber band had never been stretched that far and did not stay stretched bought silver at $30. By January 29, 2026, silver hit an all-time high of 121.67 per ounce, a 305% gain from the April 2025 ratio extreme in 8 months. In a market where professional money managers consider 15% a good year, the rubber band snapped. And the investors who saw it coming are the ones who woke up on January 29th to a number that turned $30 silver into $121 silver. Now the ratio is at 56, not 100, not 80, 56. The question on the table is not whether the prior move happened. It did. The question is whether 56 is where the cycle ends, or whether it is still a stretched rubber band that has more compression ahead. To answer that, you have to look at what stopped the ratio at 56 today versus where it stopped in previous cycles. In 2011, the compression stopped at 31 because the Federal Reserve began signaling that its extraordinary monetary policy accommodation would eventually end. The tightening narrative killed the precious metals bid. Silver crashed from $48.70 to under $10 in the years that followed as the tightening cycle took hold. Is there a tightening narrative today? The CME Group's FedWatch tool as of March 2nd shows 9.6% probability that the Fed holds rates unchanged at its March meeting. Rates are staying where they are. There is no tightening signal. There is no 2011 type narrative that would naturally halt the compression. In 1980, the compression stopped at 17 to 1 because the COMEX imposed Silver Rule 7, directly restricting the ability to buy silver futures contracts on margin. A regulatory intervention specifically designed to break the silver market halted the compression in its tracks. Is there a Silver Rule 7 today? There is not. There is no announced regulatory intervention targeting silver's rise. The COMEX has raised margin requirements, as it does when volatility spikes. But that is standard market management, not the targeted restriction that broke silver in 1980. Neither of the 2 historical precedents for stopping a ratio compression is present in today's market. The force that ended 2011 is absent. The force that ended 1980 is absent. And the forces that drove the compression are not only present, they are getting larger. The 6th consecutive deficit is confirmed for 2026. The institutional ETF buying continues. The industrial demand from solar, EVs, and AI is accelerating, not decelerating. Now let me address the honest counter-argument, because it exists and it deserves a real answer. The ratio has already moved 44 points, from 100 to 56. That is a historic compression in itself. Silver hit 121.67 in January 2026 and has since pulled back toward $90. That pullback is real. Margin liquidations are real. The market is not a straight line. Volatility in silver can be violent enough to shake out investors who entered near the January peak. And the ratio can stabilize at 56. It is not guaranteed to compress further. The 1990s and 2000s averaged 50 to 60 as a range, not a target to blow through. If this cycle normalizes at the historical range, rather than compressing to the historical extremes of 2011 or 1980, then 56 may be close to where this ends. Those are real possibilities. The math of 17 to 1 and 31 to 1 produces dramatic numbers. But those extremes coincided with specific mania conditions. The Hunt Brothers corner in 1980 and a post-financial crisis liquidity flood in 2011 that may not precisely replicate. I am not dismissing that argument. I am telling you what would need to be true for the compression to stop here. Supply deficits would need to end. 6 consecutive years of structural shortfall have not ended. They are forecast to continue through at least 2026. Industrial demand would need to collapse. Solar, EV, and AI demand are all on multi-year growth trajectories with capital already committed. Institutional flows would need to reverse. ETF inflows of 187 million ounces in a single year do not suggest institutions are exiting their positions. The Fed would need to credibly signal aggressive tightening. 95.6% of the market says that is not happening in March. For the compression to stop at 56, multiple structural drivers would need to reverse simultaneously. None of them are reversing. The deficits continue. The demand grows. The supply is constrained. The institutions are still buying. Goldman Sachs has a silver price target of $85 to $100 average for 2026. Citigroup has a target of $110 for the second half of 2026. Those are conservative estimates from institutions that are not known for sensationalism. They both imply silver is heading higher from $89 today. Neither of them is using ratio arithmetic or deficit math to get there. They are using supply-demand models, and they still get it to $110. Now let me run the arithmetic on what different ratio endpoints mean in today's market, because I want to give you specific numbers rather than abstract concepts. Gold is at $5,827 today. That number is the fixed variable in this calculation. Every scenario uses it. If the ratio compresses to 50 to 1, the long-run historical average, silver reaches $106. That is a 19% gain from $89. That is where the most conservative analysts say the cycle normalizes. If the ratio compresses to 40 to 1, which is the middle range between the historical average and the 2011 extreme, silver reaches $133. That is a 49% gain from today. If the ratio compresses to 31 to 1, replicating the 2011 cycle endpoint, silver reaches $171, a 92% gain from $89 today. If the ratio compresses to 20 to 1, not the 1980 extreme, but approaching it, silver reaches $266. And if gold continues appreciating toward JP Morgan's year-end target of $6,300, while the ratio compresses to 31 to 1, silver reaches $203. Every scenario above the historical average produces silver above $100. Every scenario at or beyond the 2011 endpoint produces silver that makes 121.67 look like an early entry point. And here is the number that might be the most important one in this entire video. The 1980 silver high of $49.45 per ounce, adjusted for inflation to today's dollars, is approximately $194 to $200 per ounce, depending on the inflation measure used. Silver has never reached its real inflation-adjusted all-time high in modern history. Every nominal dollar high has still been a real dollar underperformance relative to 1980. The 2026 nominal all-time high of $121.67 is still 40% below what silver's purchasing power peak actually was in 1980 dollars. The metal that has broken more records in the last 18 months than at any point since 1979 has still never reclaimed what it was actually worth at its peak. That gap between nominal record and real record is $70 per ounce. Closing that gap, not exceeding it, just closing it, puts silver at $194. The ratio says it belongs closer to 30 to 1. The deficit data says supply cannot satisfy demand. The institutional flows say the smart money is still buying. The inflation-adjusted history says the real high has never been touched. The Federal Reserve says rates are staying where they are. 4 separate analytical frameworks, 4 separate sets of data, 4 separate conclusions. All of them point to the same direction for the same metal. There is one signal I want you to watch from this point forward. One signal that tells you more about where the ratio goes next than any earnings report or Fed meeting or geopolitical headline. Watch whether the monthly silver close holds above $89 for March. The ratio compression from 100 to 56 happened in a price environment where silver was consistently closing months above its prior range. A monthly close below $85 would suggest the compression is pausing, possibly for months. A monthly close above $93, the high from last week, would suggest the compression has resumed its trajectory toward historical endpoints. The monthly close is the signal, not the daily noise, not the weekend swings, not any single day's move. The monthly close tells you whether institutional buying is sustaining the compression or whether the rubber band has temporarily lost its tension. Here's what I find most striking about where we are on March 2nd, 2026. The gold to silver ratio has spent 5 years traveling from 125 to 56. It fell from the highest extreme ever recorded in modern history. It passed through levels that historically produced 40, 300, and 400% silver gains on the way down. It is currently sitting at the lowest point since February 2021, and the market still has not priced in a single ounce of the sixth consecutive annual deficit that the Silver Institute has already confirmed for 2026. It is not priced in the continued institutional accumulation of 187 million ounces per year into ETFs that remove silver from the tradable market. It is not priced in the full industrial demand trajectory from solar installations that will triple by 2030, from EV production that will reach 40 million vehicles annually, from AI data center build-out that will consume trillions in hardware. It is not priced in the inflation-adjusted gap between the $121.67 nominal record and the $194 to $200 real record that silver has never touched in modern history. The ratio at 56 has already told you something extraordinary happened in this market over the last 5 years. It compressed 69 points from its all-time extreme. Silver went from $30 to $121, but compression does not stop at the first comfortable number. It stops when the conditions that drove it are exhausted. And the conditions driving this one, deficits, institutional demand, industrial growth, monetary uncertainty, are not exhausted. The rubber band is not at rest. It is still in motion. And the math at every historical resting point tells you where it stops. Above $150. So if you want to stay ahead of what's coming next, not after it happens, not when the headlines catch up, but while it's building, subscribe. Because the next move in this market won't come with a warning.